Most people have a complicated relationship with the stock market. They know it exists. They know rich people are involved in it. They have a vague sense that they probably should be doing something with it. And they are also at least a little bit convinced that it might be a giant casino designed to take money from regular people and funnel it to hedge funds and billionaires. And here is the thing: that last feeling is not entirely crazy. There are parts of the stock market that absolutely function like a casino. There are people who treat it like one, and there are Wall Street institutions that have spent decades making sure the game is tilted in their favor. But here is also what is true. The stock market, used correctly and with the right understanding, is the single most powerful wealth-building tool ever made available to ordinary people. The tension between those two things, dangerous casino and wealth-building machine, is exactly what we are unpacking today. By the end of this video, you are going to understand what the stock market actually is, how it actually works, why most people who try to beat it fail, and what the boring, unsexy, genuinely effective strategy looks like for someone who just wants to build real wealth over time. Welcome to Better Investments. Let us start from the very beginning, because a lot of people have a fuzzy understanding of what a stock actually is, and that fuzziness causes bad decisions. When a company wants to raise money to grow, build new factories, hire more people, expand into new markets, one of the ways they can do that is by selling pieces of ownership in the company to the public. Those pieces are called shares of stock. When you buy a share of Apple or Amazon or any publicly traded company, you are buying a tiny slice of that business. You are a part owner. Now that sounds almost absurdly simple, but the implications are profound. If the company does well, makes more money, grows, becomes more valuable, your slice becomes more valuable too. If the company does badly, your slice shrinks. The stock market is just the place where millions of people buy and sell those slices all day long, every day, with prices fluctuating constantly based on what buyers and sellers collectively think each company is worth at any given moment. That is it. That is the whole thing at its core. Now here is where it gets complicated. Because the price of a stock at any given moment is not purely a rational assessment of what a company is worth. It is a reflection of human emotion, fear, greed, optimism, panic, layered on top of financial reality. And that emotional layer is what makes the market feel like a casino, especially in the short term. In the short term, the market is genuinely unpredictable. Stocks go up and down based on earnings reports, economic data, geopolitical events, tweets from influential people, rumors, vibes. Trying to predict what the market is going to do next week or next month is essentially impossible to do consistently. And this is the trap that catches most individual investors. They see the market moving and they think there is a pattern. To catch a trade, to make a moment to time. And occasionally they are right, which makes it worse, because being right once or twice feels like skill when it is mostly luck, and it keeps them coming back to try again. The data on this is brutal and consistent. Study after study after study shows that the vast majority of active traders, people buying and selling individual stocks, trying to beat the market, underperform a simple index fund over any meaningful time horizon. We are talking about individual investors, but also professional fund managers. SPIVA, which is S&P Dow Jones Indices research that tracks this specifically, consistently finds that over a 15-year period, roughly 90% of actively managed large-cap funds underperform the S&P 500 index. 90% of professionals with research teams and Bloomberg terminals and decades of experience, cannot consistently beat a simple index of the 500 largest American companies. So what chance does someone trading on their phone during lunch have? Statistically, not much. But here is where the actual opportunity lives. Because while the short term is chaos, the long term tells a completely different story. The S&P 500, that index of the 500 biggest US companies, has returned an average of roughly 10% per year before inflation, or about 7% after inflation over the last century. Not every year. Some years it is up 30%. Some years it is down 30%. 2008 was a bloodbath. 2020 dropped 34% in 5 weeks and then recovered and ended the year positive. It is volatile and sometimes terrifying in the short run. But zoom out to 10 years, 20 years, 30 years, and the line goes up. Consistently. Historically. Without exception, over any 20-year period in the index history, the market has been higher at the end than the beginning. That is not a guarantee about the future. Past performance does not guarantee future results. You will hear that disclaimer constantly, and it is technically true. But it is also the most consistent track record of any asset class in history, backed by the fundamental reality that it represents ownership in real businesses that produce real goods and services for real people. Let us talk about the mechanics of how ordinary people actually access this, because it is simpler than most people realize. You do not need a broker on the phone. You do not need a financial advisor taking a percentage of your money. You open a brokerage account. Fidelity, Schwab, Vanguard, they are all free to open, and you buy index funds. Specifically for most people, a total market index fund or an S&P 500 index fund is the core of what they need. These funds buy tiny pieces of hundreds or thousands of companies simultaneously. When you put money into an S&P 500 index fund, you instantly own a tiny slice of Apple, Microsoft, Amazon, Google, Berkshire Hathaway, and 495 other companies. You are diversified across the entire American economy in one purchase. The fees on these funds are almost nothing. Vanguard, Fidelity, and Schwab offer index funds with expense ratios of 0.03% or less. That means on $10,000 invested, you pay $3 a year in fees. $3. Compare that to actively managed mutual funds, which often charge 1% or more. That is $100 a year on the same $10,000. And remember, those funds statistically underperform the index anyway. The fee difference compounds massively over decades. A 1% fee difference over 30 years can eat 25% of your ending wealth. It is not a small thing. Now, let us talk about the accounts you put these investments in, because the tax structure matters enormously. A 401k through your employer, especially if your employer matches contributions, is the single best deal in investing available to most Americans. If your employer matches 4% of your salary and you are not contributing at least 4%, you are leaving free money on the table. That match is an instant 100% return on that portion of your investment. Nothing in the market comes close to that. After capturing the full employer match, a Roth IRA is the next priority for most people. You contribute after-tax dollars, the money grows tax-free, and you pay 0 taxes when you withdraw it in retirement. On a 30-year timeline, the tax-free compounding in a Roth is extraordinarily valuable. The contribution limit is $7,000 a year for most people under 50 as of right now, with income limits that phase out the ability to contribute directly at higher incomes. After that, back to the 401k, up to the annual limit, and then taxable brokerage accounts for anything beyond that. This is the order of operations that financial planners broadly agree on, and it is worth knowing. Now we need to talk about the psychological side of this, because the strategy is simple, but executing it is genuinely hard. When the market drops 20%, and it will, it has done it multiple times in the last 25 years, everything in your brain screams at you to sell, to get out, to stop the bleeding. This feeling is not weakness, it is evolution. Human brains are wired to avoid loss more powerfully than they seek gain. Researchers call this loss aversion, and it is one of the most documented phenomena in behavioral economics. The pain of losing $10,000 feels roughly twice as intense as the pleasure of gaining $10,000. That asymmetry is devastating in investing because it causes people to sell at the bottom, locking in losses, and buy back in after the recovery when prices are high again. Buy high, sell low. The exact opposite of what you want. The investors who build the most wealth are not necessarily the smartest or the most informed. They are the ones who can sit on their hands when their instincts are screaming at them. They are the ones who keep buying during the crash because they understand they are getting shares at a discount. They are the ones who learned to be boring on purpose. There is a famous analysis that looked at which fidelity accounts had the best returns over a multi-year period. The top performing accounts were ones where the account holder had forgotten the account existed or had died. Accounts where nothing happened. No trading, no rebalancing, no panic selling. Just money sitting in the market compounding. The best investors are often the most inactive ones. Let us talk about dollar cost averaging, because this is the practical tool that makes the boring strategy work. Dollar cost averaging just means investing a fixed amount of money at regular intervals, regardless of what the market is doing. Every paycheck, every month, every quarter, whatever your schedule is, you put the same amount in. When prices are high, you buy fewer shares. When prices are low, you buy more shares. You do not try to time anything. You do not wait for the perfect moment. You just keep going. This approach removes emotion from the equation, and it works over time because you automatically buy more when things are cheap and less when things are expensive. Crypto we will cover in its own episode because it deserves the full treatment. Here is the framework for making smart decisions about the stock market. 1. Start as early as possible. The math on compound interest is almost violent in how powerful it is over long time horizons. Someone who invests $500 a month from age 25 to 65 at historical average returns ends up with roughly $2.6 million. Someone who waits until 35 to start the same contributions ends up with about $1.2 million. Same money per month, 10 years earlier start, more than twice the outcome. Time in the market is the most valuable resource you have, and you cannot buy it back. 2. Capture every employer match before doing anything else. This is free money. There is no debate here. 3. Use tax-advantaged accounts first. Roth IRA, 401k, HSA, if you have access to one. The tax savings compound just like investment returns do. 4. Buy diversified, low-cost index funds and leave them alone. You do not need to pick stocks. You do not need to find the next big thing. The whole market in a low-fee wrapper, held for decades, is the play that beats most alternatives. 5. Keep investing when it drops. This is the hard one, but the people who kept buying in March 2020, when everything felt like it was ending, were buying the S&P 500 at 2,300 points. It hit 5,000 less than 4 years later. The crash was the opportunity. It always feels like catastrophe in the moment. Here is the bottom line. The stock market is not a casino if you use it correctly. It is a casino if you treat it like one. Trading, constantly chasing hot stocks, trying to time every move, letting emotion drive decisions. But as a long-term vehicle for owning pieces of real businesses that grow in value over time, deployed through low-cost index funds in tax-advantaged accounts with consistent contributions and the discipline to leave it alone. It is the closest thing to a wealth-building machine that ordinary people have ever had access to. It is not exciting. It is not a story you tell at parties. But the boring version of this is what actually works. And working is the whole point. Next time on Better Investments, we are going to talk about gold, the oldest store of value in human history. The thing people run to when everything feels like it is falling apart. Is it actually a good investment? Or is it just a shiny rock with great marketing? We will find out. Subscribe so you do not miss it. And if this video helped the stock market finally makes sense, share it with someone who has been too intimidated to start. I will see you next time.